Hello, this is Jason Yablon, Senior REIT Portfolio Manager at Cohen & Steers. And as investors have become increasingly concerned with rising treasury yields, I wanted to talk about their relationship with real estate equities. There's really three things I want to cover. Number one, what does history tell us? Number two, what is driving interest rates today and what does that mean for real estate? And number three, as active managers, how can we mitigate and take advantage of this opportunity set? First, when we look at the history, REITs have actually performed well in rising rate environments, whether we're looking at US real estate stocks or global real estate stocks. And the reason for that is because if the rates are moving up because of improving economic conditions, landlords can raise rent, they can raise occupancy, and cash flow at the property level will increase. So even if financing costs are going up a bit in this environment, asset values can also be increasing. So when we look at the history, it's clear to us that in an environment where economic growth is improving and rates are rising, the fact that real estate fundamentals are also getting better typically win out. The second item I wanted to talk about is, well, what's happening today with interest rates and why are they rising? To answer that question, I want to focus on the 2013 taper tantrum for a moment. When we look at what happened, interest rates went up and real estate performed poorly. But when you look under the hood, what you'll find is that it was really real interest rates that were increasing then, while inflation expectations actually came down. And that was a result of the Fed taper tantrum, where investors got concerned that the Fed was going to take away the punch bowl too soon. And that was perceived as a policy error that would have negative implications for growth rates. So inflation expectations actually fell during that time frame and real interest rates increased. That's not a good environment for real estate equities. And when we look at all the historical data, what you find is that in times when real interest rates are moving up, but inflation expectations are also moving up, which is typically occurring in a time of improving economic activity, real estate performs very competitively with the broader equity market and massively outperforms the bond market. And that's the situation where we're in today, where we think interest rates are moving up because of improving economic conditions. It's the recovery trade post-vaccine distribution and increased fiscal stimulus. That is what's driving improving economic activity. And in that environment where inflation expectations and real interest rates might be moving up a bit, real estate equities can perform well with that backdrop. The third item I want to talk about is, as asset allocators, how can we allocate capital in this environment to take advantage of the dislocations that might be occurring? The first point I want to make is that not all real estate is created equal. We have some businesses with long lease duration. We have some businesses with very short lease duration. Some of our companies own hotels, which are massively economically sensitive, and some of them own long-term net leases to credit tenants, which act much more bond-like. So as active managers, we're moving the portfolio around to take advantage of improving economic growth prospects and to establish a portfolio that might benefit for rising economic growth and a rising interest rate environment. I would also like to add that things are a little bit different this time, because this economic growth that we're experiencing is partially due to the recovery from the pandemic. And there are some sectors that have historically acted bond-like that we do not think will act bond-like at all in the near future because they have been impacted by the pandemic. So in particular, healthcare, which unfortunately has been very negatively impacted due to the pandemic, historically has acted quite bond-like, quite defensive. But as vaccines roll out and as people return to assisted living, we do think that business will improve rapidly over the next several years and will not act like it has historically acted. In addition, segments of the net lease market, which is tied to the retail environment, has historically acted very bond-like, but we think it's different today because some have called into question the retailers themselves. So that business as well, as people begin to move around more post-vaccination and begin to shop in bricks and mortar on the margin a bit more, we do think there's also a recovery trade in select net lease stocks, and therefore it will not act as rate sensitive as it has historically. In conclusion, I want to leave you with a couple of points. Number one, what matters most is why interest rates are moving up not that they are just moving up. And number two, active managers can take advantage of this macro backdrop to allocate the portfolio in a way to benefit from improving economic conditions and rising interest rates. With that, thank you for your time today, and I hope to update you more in the future. Take care.